Welcome to Finance with Fairbanks, where real-world finance comes to life. Remember to like this video and subscribe to the channel. Hello and welcome. My name is Dr. Fairbanks, and in this video we are going to work through all of the necessary calculations for exam number 3. Let's go ahead and get started. In this first question, we are trying to evaluate what is known as the Fisher equation. Recall that the Fisher equation is just simply 1 plus the nominal interest rate equals 1 plus the real interest rate times 1 plus inflation. So this is the equation that we're going to use to solve the problems in this particular question. Suppose the real rate of return is 4% and the inflation rate is 3%. Calculate the nominal rate of return using the exact Fisher equation. So we'll just go ahead and subtract 1 from both sides, and we can see that 1 plus the real times 1 plus inflation minus 1 must equal the nominal rate of return in this example. Since the real rate of return is 4%, we'll take 1.04, we will multiply that by 1.03, then we will subtract 1. All right, 1.04 times 1.03 minus 1, and we can see that the nominal rate of return in this problem is 7.12%. Suppose the nominal rate of return is 8.5% and the inflation rate is 2.25%. Calculate the real rate of return using the exact Fisher equation. Once again, we will rearrange the formula. Numerator of this equation will be 1 plus the nominal. We will divide by 1 plus inflation, and then we will simply subtract 1. That is, we will take 1.085 divided by 1.0225 and subtract 1 to find the real rate of return. All right, 1.085 divided by 1.0225, subtract 1, and we find that the real rate of return is 6.112%. Last Fisher equation here. Suppose the nominal rate of return is 11% and the real rate of return is 7.75%. Calculate the inflation rate using the exact Fisher equation. Again, we rearrange the formula. The numerator is still 1 plus the nominal, but this time we divide by 1 plus the real rate, and then we subtract 1. That is, we take 1.11 divided by 1.0775 and subtract 1 to find the expected inflation rate. So 1.11 divided by 1.0775, subtract 1, and we find that the inflation rate in this problem is 3.016%. Given the following market data for Treasury securities, estimate the break-even inflation rate using the approximate Fisher equation. Recall that the break-even inflation rate takes the nominal Treasury security and simply subtracts off the real rate from a Treasury inflation-protected security. The key here is that we need to match them by their respective maturities. So we're going to calculate the break-even inflation, or BEI, for 30 years, 10 years, and 5 years. Again, to do this, we'll take the nominal rates, which is right here. These are our nominal rates, and we will subtract off our real rates, but it's important that we match them by their time to maturity. Otherwise, we have apples and oranges here. So our 30-year BEI nominal rate is going to be 4.473%. Then we will subtract off the 30-year tip interest rate, which is a real interest rate, of 2.16%, and we find a market break-even inflation rate of 2.313%. That is, investors in the fixed income market, specifically the Treasury market, are pricing in a 2.31% average inflation rate over the next 30 years. Let's see how that compares to the 10-year forecast as well as the 5-year forecast. So for the 10-year, we're going to take the 4.306%. We're going to subtract off the 1.94% from the Treasury inflation protected security. And what we find is that the 10-year break-even inflation rate is 2.366%. Again, that is, investors are expecting that rate of inflation on average per year for the next 10 years. That's suggesting that in the long run, investors are anticipating inflation to decline. Let's look at the 5-year and see if it's even higher than the 10-year. So we'll take the 4.193, that comes from the 5-year Treasury note, and we will subtract off the 1.76% from the 5-year TIPS note, and we will find that the break-even inflation rate is 2.433%. If we were to graph this, what we would realize is that investors are expecting inflation to fall in the long run, but they're anticipating higher inflation in the near term based on the information on this slide. All right, we're done with our interest rate discussion. We're now moving into the stock valuation and dividend forecasting and total return and those types of calculations. First up, we have Fair & Co. just paid an annual dividend of $2.11 per share. Again, that just paid tells me it is Div 0. Dividends are expected to grow at 3.5% forever. Calculate the value of the dividend at the end of year 1, the end of year 2, the end of year 6, and the end of year 11. Again, the words just paid are very important to us because that tells us that that is our dividend that was just paid today. That is our Div 0. They give us the forever growth rate of 3.5%, and we'll go ahead and set this up. Now, our objective in this problem is to forecast these dividends out into the future. We will use our Div 0 as our benchmark value. That's what we're going to use to forecast the future dividend. Now, to find the time 1 dividend, we'll simply multiply that by 1.035. Then to find the time 2 dividend, we'll multiply that by 1.035 squared. Alternatively, I could have simply taken the Div 1 and just multiplied it by 1.035. We would get the same answer. For Div 6, we will multiply it by 1.035 raised to the 6th power because we're sending the time 0 dividend all the way to the end of year 6. And last but not least, we're going to find the time 11 dividend, so we will raise that to 11. All right, first up is Div 1, so we will take 2.11 and multiply it by 1.035. That's 1 plus the dividend growth rate. And what we find is that dividend is $2.18. I'm going to go ahead and multiply that again by 1.035, and that's going to be our time 2 dividend. And what we notice there is that the time 2 dividend is $2.26. Now I'm going to reset for the last two. I'm going to take Div 0 and multiply it by 1.035 raised to the 6th power. And what we find is that the dividend at the end of year 6 is $2.59. For that last dividend, we'll take $2.11. We'll multiply it by open parentheses 1.035 raised to the 11th power, and we find that that final dividend is $3.08. Okay, so we found that the dividend 1 year from now is $2.18. We found that the dividend at the end of year 2 is $2.26. The dividend at the end of year 6 was $2.59. And last but not least, the dividend at the end of year 11 was $3.08. In this problem, we are working on questions that are related to the zero growth model. Recall that the zero growth model is simply the perpetuity formula. That is, the present value of the expected future cash flows is just the dividends divided by the required rate of return. Collect Co. pays a constant dividend of $5.11 per share on its preferred stock. Calculate the price per preferred share, assuming investors require a 7.5% rate of return on their investment. All we're going to do to find the answer to this question is simply take the $5.11 perpetual dividend and divide it by 0.075, and we'll get an answer. And what we find is that we would be willing to pay $68.13 to acquire a single preferred share in Collect Co. Winnie Inc. pays a constant dividend of $3.25 per share on its preferred stock. The preferred shares sell for $42.66 per share. Calculate the required rate of return on this investment. All we're going to do is simply rearrange the formula, and now we have dividend divided by price, which hopefully you recognize that that is in fact the dividend yield. So we're going to take the $3.25 and simply divide it by the $42.66 price per share, and we will find the required rate of return on this investment. And we find that the required rate of return on this investment is 7.618%. Last up, we have Cashco's preferred shares sell at $125 per share. Investors require a 5.5% rate of return on their investment. Calculate the amount of the dividend. Again, if we rearrange the formula, we'll simply take the price, or the present value, and we will multiply that by the required rate of return. That will give us the perpetual dividend. So we take 125, we multiply that by 5.5%, and what we find is that the perpetual dividend is $6.87.5. In the next two slides, we're going to work on questions that are directly related to the constant growth model, or Gordon model. It's important that we remember the mathematical formulas here, and that is that the present value is equal to the dividend next period, or the dividend that will be paid 1 year from now, all divided by R minus G. And of course, this is the growing perpetuity formula. It does have a constraint, and the constraint is that the required rate of return must be greater than that dividend growth rate. We can also write this as div 0 times 1 plus G, as we saw when we were forecasting those dividends a few examples ago. And we'll simply, again, divide that by R minus G. That's why it's so important as we work through these problems that we really pay attention to the wording. King Incorporated just paid, again, what that tells me is div 0, a dividend of $1.23 per share. Dividends are expected to grow at 3.22% forever, and investors require a 9% rate of return on their investment. Calculate the price per share of the common stock. So we will say, we'll take that $1.23 dividend, but we have to grow it at that 3.22%. So we'll multiply that by 1.0322, and then we will divide it by 0.09 minus 0.0322, and that will give us the price of the common stock. We'll take 1.23, we'll grow that dividend by 1.0322. So the time one dividend, or the dividend that will be paid 1 year from now, is approximately $1.26. We'll call that $1.27. We're then going to divide that by, open parentheses, 0.09 minus 0.0322. And what we find is that the price of the common stock is $21.97. Cashco will pay a dividend of $4.82 per share next year. That obviously tells me that this is the dividend that will be paid, or div 1. Dividends are expected to grow at 2% forever, and investors require a 9% rate of return on their investment. Calculate the price per share of the common stock. This one is much easier because we don't have to grow the dividend. We just take the $4.82 and simply divide it by 0.07, which is the required rate of return, minus that dividend growth rate of 2%. So we'll take 4.82, we will divide that by 0.07, and we find that the price of the common stock is $68.86. Now in these next two questions, we're going to actually rearrange the formula a little bit. Smarty Inc.'s stock sells for $68.25 per share. The company will pay a dividend of $2.98 per share next year. Dividends are expected to grow at 3.5% forever. Calculate the required rate of return on the investment. Rearranging the formula and solving for that required rate of return, what we can find is that the dividend divided by the price plus the dividend growth rate is equal to the required rate of return on the investment. Another way to look at this mathematical equation is to say the total return is equal to the dividend yield plus the capital gains yield. Recall that the stock price appreciates at the same rate as the dividends themselves. So we can take that next dividend of $2.98, we'll divide it by the $68.25 price per share. We will then add back the dividend growth rate of 3.5%, and that will give us the required rate of return on this investment. So $2.98 divided by 68.25, and we add back the 0.035 dividend growth rate, and we find that the required rate of return on this investment is 7.87%. League One company will pay a dividend of $3.33 per share next year. The stock currently sells for $72.35 per share, and the required rate of return is 9%. Calculate the dividend yield and the capital gains yield. Now recall that our total return is simply equal to our capital gain percentage plus our dividend yield. And we know that our total return in this model is R and our capital gain is G. So if we want to find the dividend yield must equal R minus G. We also know that the dividend yield is equal to the dividend that will be paid, all divided by the price per share, which is the information that's given in this particular question. So we'll take the $3.33 dividend that will be paid 1 year from now, and we will divide it by the $72.35 price per share. That will give us R minus G. Now we already know R. R is 9%. What we want to do next is find the capital gain. We want to find G. And to do that, G will simply equal that 9%, or the total return, minus whatever we find for that dividend yield. Okay, so we'll take the $3.33 dividend divided by the $72.35 price per share, and we find that the dividend yield on this investment is 4.603%. Now we're going to take 0.09 and subtract off that number, so I'm going to hit second and equals. That was the last calculation that we did in the calculator. It's stored in memory, and then we'll simply hit equals, and we will find that G equals 4.397%. And of course, the sum of those two numbers does equal 9%, or the total return on this investment. Okay, again, our dividend yield was 4.603%, and our capital gain, if you want to think of it like that, because that's what it is, or dividend growth rate, is equal to 4.397%. This is comparable valuation, and recall from lecture that when we're trying to estimate the price of the stock today, what we do is we first have to calculate the company-specific values. Once we have the company-specific values, we can then multiply by the appropriate industry benchmark. Now, in this comparable valuation, we're using 3 industry ratios. We're using the price to earnings ratio, the price to sales ratio, and a price to book ratio. So we're going to use those industry ratios as our benchmark measure, and we're going to multiply them by their respective company values. That means that we need to find the sales per share, we need to find the earnings per share, and we need to find the book value per share. Notice that we're not finding the book value of the assets, we're finding the book value of the equity in this particular analysis. Okay, to find sales per share, we're going to take the 254.19 billion, those are in billions of dollars, this is real data by the way, divided by the number of shares outstanding for Microsoft, and that's 7.43 billion shares outstanding. For the earnings per share, we're going to take the net income divided by the shares outstanding. So we'll take the 90.512 billion in net income, and again we'll divide it by the total number of shares outstanding. Last but not least, we'll take the book value of the equity, $268.47 $0.477 billion, and then we'll divide that by 7.43. Once we get those numbers, we're then going to multiply them by their respective benchmarks, and that will give us a price estimate. So let's go ahead and start with the price to earnings ratio, which means we need the earnings per share. So we'll calculate the earnings per share, we'll multiply it by the 7.2, and we will get a price estimate for Microsoft. Again, the net income was $90.512 billion. We're going to divide that by the $7.43 billion outstanding. That gives us an earnings per share of approximately $12.18. We're then going to multiply that by the 56.8 PE ratio. Again, that's an industry PE. And what we find is that the price estimate of the stock is $691.94. So our EPS was $12.18. We took that and multiplied it by their respective industry benchmark PE of 56.8, and we found a price estimate of $691.93. Now, given that Microsoft is currently trading for $418, if you believed that this industry ratio is correct, we would say that they were undervalued and we would probably give a buy recommendation. However, I personally would not just do one particular comparable valuation to make my decision as to whether or not I should buy or sell a particular stock. Let's try sales per share next. So we'll take the 254.19 in sales, we'll divide it by the 7.43 billion shares outstanding, and then we'll go ahead and multiply it by the ratio of 7.2. Let's see what we get. All right, so we're going to take the sales, the top line number on the income statement, divide it by those shares outstanding. That's going to give us a sales per share of $34.21. We'll go ahead and multiply that by the industry benchmark, PS, or price to sales ratio of 7.2, and we find a price estimate on Microsoft of $246.32. Now this is giving us a different signal than the PE ratio, because with the price to sales, we got a much lower price estimate. In fact, it was significantly lower than what the stock is trading for. And if we believed that this one was correct, we would give a sell recommendation because my estimated price is significantly less than what it is currently trading for. All right, last up we have book value per share, and then we're going to multiply that by 9.5. So the book equity is $268.477 billion divided by the 7.43 billion. That gives us a book value of equity per share of $36.13. I'll go ahead and multiply that by 9.5, and we find a price estimate of $343.27. This one is not within what I would deem to be a tolerance range, but again, it's leading to a similar signal as the price to sales, and that is it's a much lower price estimate than what it is currently trading for, and maybe we would give a sell recommendation based on this information. So they weren't all conclusive in that regard. One gave us a buy recommendation, the other two gave us a sell recommendation. What that tells me is we need to do a lot more work before we go ahead and buy Microsoft's stock or even sell it. We are now moving into director voting, and we're going to look at two different situations. A situation where the company uses straight voting to elect its board of directors, and a situation where its board of directors are elected via cumulative voting. Taylor Co. has 650,000 shares outstanding with a current market value of $20 per share. At this year's annual shareholder meeting, 3 out of 12 directors will be up for election. Well, when we're trying to evaluate the number of shares required using straight voting, we don't need to know the number of directors that are up for election in a particular year. Why? Well, because we need 50% of the shares outstanding plus one more to guarantee ourselves a seat on the board under this type of director voting. That means we're going to take 50% times the 650,000, which will be 325,000. Then we're going to add one more share. That means it's going to require us to have 325,001 share to guarantee ourselves a seat on this board. The cost of those shares is $20 per share. We're going to multiply that by 20, and when we do this, we find that it would cost us $6.5 million and an extra $20, in fact, because we need that one extra share. All right, next up we have cumulative voting. And with cumulative voting, we use a different mathematical function. We use 1 over n plus 1% plus one more share to guarantee ourselves a seat on the board. The number of directors that are up for election does matter with this style of voting. So we're going to take 1 over 3 plus 1, which is equal to 1/4 or 25%. That is, we will take 25% of the 650,000 shares outstanding, which will be 162,500. But we need one more share. So that means that we need 162,501 shares to guarantee ourselves a seat on the board at a cost of $20 per share. That means that it's going to cost us $3.25 million plus another $20 to guarantee ourselves a seat on the board under cumulative voting. We are now transitioning into our capital budgeting tools. So this requires us to find net present value, internal rate of return, the payback period, the profitability index, and maybe even the crossover rate. In this particular problem, Fair & Co. is considering the following project. The CFO requires an 8% rate of return on invested capital. We are going to calculate NPV, IRR, PB, and PI. I'll go ahead and start with the payback period. And to do that, I'm going to create an extra column here, and I'm going to call this column the remaining balance. The remaining balance, once we take on the project, is what we paid to start the project, or in this case, the $45,750. Now, at the end of year one, we're going to receive $12,250. So we're going to add that to the remaining balance. And what we find is that we still have, after we've received this cash flow, $33,500 is what we still have to receive. Now we'll go forward another year, and we see that we'll receive another $12,250. So we'll go ahead and add that to our remaining balance. And what we find now is that we still need to recover $21,250. Move forward one more year. And what I find is that I need to recover $8,750. That's after adding back the $12,500. Do notice that the cash flows do change there on the timeline. I'm not going to go any further, and the reason for that is because the time for cash flow is greater than the remaining balance that I need. Recall that once that remaining balance goes from negative to positive, that is, you have a negative remaining balance and then you will have a positive remaining balance, that our payback period has to fall somewhere between the end of year 3 and the end of year 4. And what that means is that it can't be less than 3 years and it can't be greater than 4 years. Additionally, our payback period will be 3 plus this remaining balance on an absolute value term. So we'll take the $8,750, I'm ignoring the negative sign, and then I'm dividing it by the next cash flow that I will receive at the end of year 4. And when I do this in the financial calculator, I find that the payback on this particular project is 3.583 years. Okay, so we found the payback period. which our calculators in its basic format cannot do, that means that we're going to use the cash flow worksheet to help us solve for these other three tools, the NPV, the IRR, and the PI. Now to do that, we're going to plug these into our financial calculator. This will be our CF0, and this will be C01, C02, C03, C04, and C05. So we'll plug those cash flows in just as they appear on the timeline, which will make things much easier for us. I go into my cash flow worksheet. Make sure you clear it out, obviously, because you don't want any stored cash flows there. So we'll start with CF0. That cash flow is $45,750, but it is a negative value. And then we'll hit enter. We'll arrow down to C01, and we will type 12,250. I could use the frequency tool here, but I'm not going to. We'll just go ahead and type these in as they appear on the timeline. So 12,250 again. C03 is 12,500. C04 is 15,000. And C05 is also 15,000. Always double check that you have entered in everything correctly into the financial calculator, because it's really easy to have a transposition error. We will then go into our NPV worksheet. We'll enter a value of 8 in for I. That's because the discount rate or the required rate of return in this problem is 8%. We will arrow down and we will compute the net present value. And what we find is that the NPV in this problem is $7,252.09. Now, rather than going back to the PowerPoint, let's just go ahead and calculate IRR and PI, since we already have the cash flows in here. So I'll go right over to the IRR worksheet and hit compute. And what I find is that the internal rate of return on this particular project is 13.59%. Now, there's a trick that we can do in our financial calculator to find the profitability index. Notice the methodology that I'm using. I first solve for NPV, I then find the IRR, and I'm finishing my calculation by finding the profitability index. Now, to do this, I'm going to go back into my cash flow worksheet. I'm going to change my initial cash flow to 0. Then I'm going to go back to my NPV worksheet and recompute the net present value. You can view this number as the present value of the cash flows from time 1 to time 5, all brought back to time 0. That's what this number represents. And so the last step here is then to divide by the absolute value of our time 0 cash flow. That's $45,750. So when I do that, I find that my profitability index in this problem is 1.1585 overall. That means if I invest $1 into the project today, it will return to me $1.16 in today's dollars. Very important that we recognize that. Again, let's just write down the answers here. So we found a net present value of $7,252.09. We found an internal rate of return on this project of 13.59%. And we found a profitability index of approximately 1.1585. Now again, I'm going to give you those step-by-step tools in the calculator. Okay, so these are my calculator steps for finding the profitability index. So the first thing that we did was we went back to the cash flow worksheet and we set our initial cash flow equal to 0. Then we recomputed the NPV. And last but not least, we divided by the absolute value of the initial cash flow. Those were the steps that I used, again, after I found NPV and after I found IRR to solve for the profitability index. There's also another trick if you're confused with that methodology, or maybe you forget that methodology on the exam. You can also do this. The profitability index is equal to the net present value that you solved for over here, plus the absolute value of the initial cash flow. What I mean by that is essentially we're ignoring the negative sign when we do this, all divided by the absolute value of the initial cash flow. That's it. That is our profitability index. King Cash Inc. is evaluating two mutually exclusive projects. Recall that when we see the words mutually exclusive, we only have a few options. We can either accept A and reject B, or we can reject B and accept A, or we can reject both. We cannot accept both projects when we are evaluating them in a mutually exclusive framework. Now in this problem, we're going to do what we did in the prior problem, and that is we're going to find the net present value, the internal rate of return, the payback period, and the profitability index. But we're also going to find a new metric called the crossover rate. Okay? Now to find the crossover rate, we're going to need an additional column, and that column is going to be the difference column. And when I do a differential, I usually like to take the larger project minus the smaller project, but honestly it doesn't matter. You can do the cash flows of A minus the cash flows of B, or you can do the cash flows of B minus the cash flows of A. The key is to be consistent when you're creating this particular column. I'm just going to do left to right, so we're going to take A minus B. That means that my first cash flow is a positive $103,000. The next one up is $105,000 minus the $74,500. That's a positive $30,500. The next one will be negative $4,500, followed by a negative $37,400, and then we have a negative $92,000, and last but not least, we have a negative $119,500. To find this crossover rate, we have to do this calculation. Once we do that, we'll plug those cash flows into our cash flow worksheet, and we will solve for the internal rate of return. But let's go ahead and set up a table over here. And let's do it right here. So we'll set up our table. Here's NPV. Here is my IRR. And here is my profitability index. We'll save PB for last because it takes some extra effort to actually do that calculation. And we're going to find all four of these metrics for Project A as well as Project B. To do this, we will need our cash flow worksheet. Go into our cash flow worksheet. Let's go ahead and clear this out. So we're going to put in all of the cash flows for Project A and only A. The time zero cash flow for Project A is a negative $215,000, followed by a positive cash inflow of $105,000. And then our year two cash flow is $92,500. Our year three cash flow, $87,600. And our time four cash flow, $78,000. Our time five cash flow, $70,500. We've entered in all the cash flows. We know our discount rate is 7% in this particular problem. We'll go over to our NPV and enter 7 for I, arrow down and compute the net present value. We find that the net present value on Project A is $145,202.97. We'll then go over to our internal rate of return and hit compute. We find an internal rate of return of 31.73% for this particular project. We'll use the trick that we learned in the prior example. We'll go back to our cash flow worksheet. We will set our initial cash flow equal to 0. We will then go back to NPV and recompute. We will then take this number and simply divide it by $215,000, the absolute value of the time zero cash flow. That represents our profitability index for Project A. So the PI is 1.675 for Project A. Let's go ahead and jot this down before we have to clear out our cash flow worksheet. Again, we found a net present value of $145,202.97. We found an internal rate of return of 31.73%. And we found a profitability index of 1.675. Let's go into the worksheet now and redo all of this for our Project B. So B is a much larger project. Its initial cash outflow is $318,000. It's followed by a cash flow of $74,500 and $97,000. And then the end of year 3, it's $125,000. End of year 4 is $170,000. and the end of year 5 is $190,000. We'll go over to the NPV. Since I cleared the worksheet, I have to re-enter the discount rate of 7%, recompute the net present value. We find that the net present value of Project B is $203,546.52. We'll go over to the internal rate of return and compute it. We find an internal rate of return of 24.94%. We'll use that trick to find the profitability index, so we'll go back to our cash flow worksheet. We'll enter a value of 0 for our initial cash flow. We'll click on the NPV, arrow down, and recompute. Again, that represents the present value of the time 1 through time 5 cash flows. We will then divide that number by the absolute value of the time 0 cash flow, or $318,000. And what we find is that the profitability index for Project B is 1.64. That is, we put in $1 today and it returns $1.64 in today's dollars. What we've learned here in terms of this information is that we would definitely want to accept Project B. And the question would be why? Well, we want to accept it because it has a much higher net present value. And our internal rate of return is 24.94. Notice that the internal rate of return on A was higher. That's the conflict that we talked about in class. Additionally, the profitability index on Project A was higher. We don't care about those other metrics. NPV is king, and we're trying to increase shareholder wealth, so we're going to accept Project B. Now, that leaves us with trying to find the PBs for both of these. Now I can visualize this here, that when I take the time 1 and the time 2 cash flow, I add them up, it's not quite enough to cover the initial cash flow for Project A. So Project A is going to fall somewhere between 2 and 3 in terms of its PB. We'll call that PBA. It's going to start with a 2. And what I'm going to do in the calculator is I'm going to take the 215, I'm going to add 105, I'm going to add the 92.5, and then what is ever remaining, I'm going to divide it by that 87,600. That will help me get to the payback period for Project A. Now for Project B, let's look at that. That's going to take at least 3. So it'll be somewhere between 3 and 4 for Project B. That means we're going to have to add this one and this one and this one. It won't be enough, but once we get to the 170, it will be. So my payback for Project B will start with a 3, and then it will be divided by $170,000. So this is what I meant. We're going to create a remaining balance column for Project A without actually creating the remaining balance column. I'm going to take the $215,000, put a negative sign in front of it. I'm going to add the $105,000, which is the time 1 cash flow. That tells me I have a remaining balance of $110,000. I'm then going to add the $92,500 to that, and I find that I still need to recover, or I have a remaining balance of $17,500. But if you look, the time 3 cash flow is $87,600. So what I'm going to do is I'm going to remove that negative sign. I'm going to then divide it by that $87,600. And what I find is that it's 0.19977 years. But we need to add 2 full years to that. And we get 2.2 years in terms of a payback period for Project A. Now let's do this again with Project B. We'll take the $318,000 that we spent on the project. We'll add that time 1 cash flow to it. We'll add that time 2 cash flow. And we will add the time 3 cash flow. And we still have not recovered, but notice that my next cash flow is $170,000. That means that we have a payback period of 3 plus whatever this ratio is. I'm going to remove the negative sign, divide by the $170,000, and add 3, and I get a payback period of 3.126 years. So not only did the Project A have a quicker payback, it had a higher IRR, it had a higher profitability index, but at the end of the day, its net present value was much smaller than Project B, and of course we would want to accept Project B in that particular scenario. Okay, we're not quite done with this problem. We do need to find the crossover rate, so let's go ahead and do that. That's going to require us entering in all of those values into our cash flow worksheet. Make sure you clear it out, of course. So we'll go in here, we'll enter 103,000. This is the difference column that we are entering now. So we're entering that difference column. My time one cash flow now is 30,500. My time two cash flow is a negative $4,500. My time three cash flow is a negative 37,400. My time four cash flow is a negative 92,000. And last but not least, my time five cash flow is a negative $119,500. I will then go over to the internal rate of return and I will hit compute. And I find that the crossover rate in this problem is 17.27%. Now, you might be wondering, well, why do we even care about the crossover rate? Because we solved for NPV and we found that the NPV for Project B was actually higher than the NPV of Project A. Well, what we would really want to do here is we would want to build this in Excel, and we would want to build these NPV profiles. But we can get an idea and we can get a sense of what these NPV profiles might look like just through their internal rates of return. Now, we know that the internal rate of return for A is significantly higher than that of B. Let me use a different color here on this graph. So let's say that this project is A. This is Project A. How do I know it's Project A? Because its internal rate of return is 31.73%. Now the other line here is Project B, and its internal rate of return was 24.94%. We also know that the crossover rate, the point where the NPV of A is equal to the NPV of B, was equal to this 17.27%. But think about it. Which project did we accept? We accepted Project B. That's because our discount rate was significantly lower than our crossover rate of 17.27%. And in that scenario, you can see that B should have a higher net present value. However, if our discount rate was, say, 20%, well, if our discount rate was, say, 20%, in that case, we would not want to accept Project B. We would want to accept Project A because its NPV would be higher. And that's the whole purpose of finding this crossover rate in these mutually exclusive capital budgeting projects. We are now moving into our return analysis and our return discussion. We're going to begin by talking about dollar returns and percent returns, and then we will start to look at what we call return statistics. Let's go ahead and get started. Last year, Kingston purchased 500 shares of XYZ stock at $32 per share. Today, the stock pays a dividend of $2.60 per share, and he sold his shares for $30.75 each. Calculate the total dollar return, the capital gain income, as well as the dividend income in this particular example. When we are calculating returns from a dollar standpoint, the number of shares or the number of bonds is very, very important. When we look at the percentage side of things, the number of shares becomes irrelevant. When we're trying to find our total dollar return, we're going to take the shares that we own and we're simply going to multiply it by the price that we sold it for minus the price we paid plus any income that was received. In this case, it would be the dividend 1 year later after the purchase of the stock. So we will take the 500 shares that Kingston owns. We will multiply that by the $30.75 per share that he sold those for. He, however, paid $32 per share to acquire them. and he received a $2.60 dividend. When I do this in the calculator, I find that the total dollar return on this investment was $675. But let's break it down. Let's look at the capital gain or loss. And in this case, it is a loss because he sold it for less than what he paid for it. Now in this, we're just going to simplify the equation. It will be the shares that we own times the price we sold it for minus the price we paid for it, or 500 times the $30.75 minus 32, and his capital loss in this particular example was a negative $625. Next up, we'll look at his dividend income, or dollar dividends if you want to think of it like that. Again, that's going to be the shares that he owns times the dividend that he received. So we'll take the 500 shares and we'll multiply that by $2.60. And what we see is that his dividend income is equal to $1,300. And of course, if we take that $1,300 and we add the negative $625, we find that his total return in dollars was $675. Last year, Cashton purchased 250 shares of ABC stock for $45 per share. Today, the stock paid a dividend of $3.15 per share, and he sold his shares for $47.12 each. Calculate the total return percentage, the capital gain yield, as well as the dividend yield. So my total return percentage is based on the following equation. And in this analysis, the number of shares that he actually owns is not even relevant. The numerator to this problem is the price that we sell it for minus the price that we paid plus any income that was received, all divided by the initial price that we paid. In terms of our capital gain or loss percentage, what we would want to do is take the price that we sold it for minus the price we paid, all divided by the price we paid in that particular example. And last but not least, we have the dividend yield. We learned this back in chapter 2. We know that the dividend yield is simply the next dividend or the dividend income that we received divided by what we paid for that asset. Let's go ahead and plug these numbers in. We have $47.12 minus $45 per share plus $3.15 in dividend income. We'll divide all of that by 45. Then for the capital gain, we'll just simply take $47.12 minus the $45 per share, all divided by 45. And last but not least, we will take $3.15 divided by the 45, and that will give us our dividend yield. Let's calculate the total return first. So we'll take the $47.12. We will subtract off the $45 per share that he paid. We'll add in the $3.15 in dividends that he received per share, and then we will go ahead and divide that by $45, the price that he paid. So the total return percentage on this particular investment was 11.711%. Now in terms of his capital gain yield, we'll take the $47.12, we'll subtract off what he paid, then we will divide that number by what he paid, and we find that his capital gain percentage, or the price appreciation in the asset, was 4.71%. Last but not least, we have the dividend yield. We'll take the $3.15, and we will go ahead and divide that by 45. And what we find is that the dividend yield on this investment was, in fact, 7%. Of course, I could have just taken the total return and subtracted off the capital gain percentage to find that dividend yield, but it's always best to double check your numbers, and that's what we did. Calculate the arithmetic and geometric average return and the dollar invested equivalent and the 5-year holding period return. Well, what I can tell you is that for the geometric average, the dollar invested equivalent, and the 5-year holding period return, we're going to have to create an additional column on this table. That additional column is called the 1 plus the return column. That is, I'm just adding the value of 1 to each one of these returns. So I get 1.12, I get 0.949, I get 1.159, I get 1.185, and I get 0.978. So all I did was add the value of 1 to each one of those returns to calculate this column. Again, why did we do that? We did that so that we can find these three statistical measures, which are really, really important when we're talking about return statistics. With regards to our arithmetic average, we could use our financial calculator to do this. However, all we have to do is take the sum of these returns and then divide by 5. So we'll sum the returns, if we want to think of it like this, sum the returns and divide by n. In this case, there are 5 returns. That will be our arithmetic average rate of return. So let's start there. We'll just call that average because that is what the average is. It's just the arithmetic average. We'll take 0.12 plus 0.051 negative plus 0.159 plus 0.185 plus 0.022 negative. That is the sum of those returns. We will now divide by 5, and we find that the arithmetic average return in this example is 7.82%. All three of these last remaining metrics here are related in one way or another. Let me start with the geometric average equation. So the geometric average equation is this. It takes all of these 1 plus the returns. It essentially takes the product of the 1 plus the returns. So we take 1.12 times 0.949 times 1.159 times 1.185 times 0.978. Then we take all of that. That's the product. Okay, this whole thing right here is the product. We're going to need that number for something else. We'll then raise all of that to the 1 over 5. Why 5? Because n is 5. And then we will subtract 1. That will be the geometric average return. But what we have to remember is that when we take the product of these 1 plus the returns, that is the inside part of this particular equation, what we are finding is the dollar invested equivalent. I like this metric because what it says is, had I invested $1 at time 0 into this specific asset, what would that dollar be worth at the end of the 5-year holding period return? Well, that's what this metric tells us, and that's pretty cool. The other cool aspect of this is it's scalable. So if I say, well, I actually invested $25,000, I just take the $25,000 times this dollar invested equivalent, and that would tell you the balance of your account at the end of year 5. Next up, we also can use this to find the HPR. The HPR is simply the dollar invested equivalent minus 1. HPR stands for the entire 5-year holding period return. It's not looking at, what is your average return in a given year. It's saying what was your total return that you observed over the entire investment horizon. So we take that dollar invested equivalent and we simply subtract 1. Now that won't be $1, that'll actually be a percentage, whatever that answer is that we find in the financial calculator. That means that when I start this problem, I'm going to do the inside part of the geometric average. That's going to represent the dollar invested equivalent. I'm going to then raise it to the 1/5 power and subtract 1, find the geometric return. I'll circle back and subtract 1 then to find the HPR. Okay, so let's do this in the calculator. We're going to go 1.12 times 0.949 times 1.159 times 1.185 times 0.978. Again, that is the product of the 1 plus the returns. That represents the dollar invested equivalent. We see that if we had invested $1 in this asset at the beginning of the investment horizon, it would be worth $1.4277. Again, that's beautiful because we can scale it. If we subtract 1 from that number, we find the total holding period return, the 5-year holding period return, and that is 42.77%. But we're after finding the geometric average. We know that the geometric average has to be less than the arithmetic average, but let's go ahead and confirm that. We're then going to raise this to the open parentheses 1 divided by 5, and then we're going to subtract 1. And we find that the geometric average return in this question is 7.38%. Okay, let's write this all on the slide so we have a record of our answers. Our geometric average return was 7.38%. Our dollar invested equivalent was $1.4277, and we found that the HPR was 42.77%. In this problem, we're going to continue to use the same data. However, we're going to use our financial calculators to help us solve for a lot of this information. When we enter these returns into our financial calculator, we're going to enter them in as the X values only. We don't want to mix and match between X and Y. This is just one variable, so we want to make sure that as we enter them into the data worksheet, that we remain in the X values and completely ignore the Y values. Now, if we had two different series of returns, we could enter in the Y values. We could even run regressions in the financial calculator, which is pretty cool. When we go to the stats worksheet, we're going to find, again, the arithmetic average. Now, we already know the answer to this because we saw it on the other slide or the prior slide, but it's going to be represented as X bar. They're then going to give us S of X, and they'll give us sigma X. I don't want you to use sigma X. That's going to be representative of the population standard deviation. In contrast, S of X is going to be representative of the sample standard deviation. Now, as we learned in class, standard deviation, the variance is the squared deviations from the mean. And then we take that variance and we take the square root of it to find the standard deviation. We like standard deviation because it's in the same units as the mean. Now, once we have the standard deviation and once we have the average rate of return, what we're going to do is use the 68, 95, 99.7 rule, and we're going to find the lower bound and the upper bound for the specific confidence intervals. That is, we're going to assume mathematically that the returns come from what we call a normal distribution. So we know that the 68 confidence interval is plus and minus 1 standard deviation. The 95% confidence interval is plus or minus 2 times the standard deviation. And last but not least, the 99.7 is 3 times the standard deviation. And that's how we'll go ahead and calculate this information. But let's show you how to use this particular worksheet. It's a pretty cool worksheet in the financial calculator. You can see here it's the 7 and 8 key. If you want to write that down, that's a good thing to remember. Your data worksheet is second 7. So let's go in there. Just like clearing the cash flow worksheet, we want to clear this out. You'll notice that you have an X01. That's your first X observation. If I arrow down, that's a Y01. This is what I meant by keeping everything within the X values. So I'm going to enter in my first return. That's going to be 12%. We'll hit enter. Arrow down 2 times. I'm skipping over the Y values. I don't have a second variable here. My second value for X is going to be 0.51 and negative. We'll hit enter. We'll arrow down again. We'll type 0.159 and enter. That's our third return. Arrow down 2 times. 0.185, enter, arrow down 2 times, and last but not least, 0.022 negative and enter. Always double check, just like the cash flows, that everything has been entered into the calculator correctly, and it has. Now we can move on. We're going to go into the stats worksheet by hitting second and 8. Now this is assuming linear estimation. They've got other estimations. We won't go into that in this class, but let's arrow down. That confirms that we have 5 observations. It says n is equal to 5. That's fantastic. There is our arithmetic average return of 7.82%. Again, if I arrow down, that is our standard deviation on a sample standard deviation, and that's the one that we want to use at 10.77%. There is our population standard deviation. We're not going to use that. And of course, we don't have any y values, so we're done. We have the information that we need to answer this particular question. Again, our arithmetic average was 7.82%. Our standard deviation was 10.77%. The one thing that we didn't do was we didn't find the variance. And the variance is just the standard deviation squared. So just remember that, just square the standard deviation. That's why we take the square root. If we're given the variance, we take the square root to find the standard deviation. We can go back and we can look at that, and we can just simply square it, and that is our variance at 0.0116. I tend to prefer the standard deviation because it's in the same units as the mean, and the variance is just difficult to interpret. Let's start with our upper bounds. I always find it easier to start with the upper bounds. So our upper bound, our first one is going to be that x bar simply plus 1 standard deviation. That's it. That means I'm going to take the 7.82, I'm going to add the 10.77, and I find that my upper bound is 18.59%. Now the next one is x bar plus 2 times the standard deviation. Well, here's a cool trick. All you have to do is add another standard deviation to that upper bound, and when I do that, I find that this upper bound is 29.36%. That is, I took this 18.59 and I simply added another 10.77%. Last but not least, to do 3 standard deviations, again, I'm just going to add another 10.77 to this number, and I find that the upper bound is 40.13%. Let me show you how I do this in the calculator. Again, I'm going to take that 0.0782, I'm going to add 0.1077, and that is our first upper bound. Our next upper bound is another 0.1077. That's the 29.36. And last but not least, we'll add one more standard deviation to it. And we find that the 99.7% upper bound for the confidence interval is 40.13%. Okay, we'll take a similar approach for our lower bound, but this time we're going to be subtracting off. That is, for this number, we're going to take x bar, which is our arithmetic average, and we're going to subtract off 1 standard deviation. So I'm going to take 7.82%, I'm going to subtract off the 10.77%, and I find a lower bound of negative 2.95%. Now the question is, why do we care? Why do we care about finding this information? Well, what this tells me is if these returns truly do come from a normal distribution, then 68% of the time those returns should fall somewhere between negative 2.95% and 18.59%. Now, similarly, we're going to subtract off another 10.77%, and we find that the lower bound on the 95% confidence interval is negative 13.72%. That is, 95% of all returns that come from this asset should fall within that particular range. Last but not least, we're going to do another standard deviation, and we find negative 24.49%. I want you to think about this for a second. What this is telling us is that 99.7% of all of the returns for this asset should fall between negative 24.49% and a positive 40.13%. That's pretty cool. Okay, last problem here. It says, last year, Gwenny earned 11.3% on her investment, while U.S. Treasury bills earned 3.8%, and the inflation rate was 3.5%. Calculate her risk premium on her investment. Now, we can calculate 2 different risk premiums. We can calculate what is known as the nominal risk premium, and that is simply going to equal your return minus the risk-free rate. Now, the key in these problems is to remember that in finance, we assume that our Treasury or our U.S. Treasury bill is our risk-free rate. That's what we assume. We assume that this, whatever this value is, that is our risk-free rate. And again, the risk premium is the return above the risk-free rate that you earned, or the excess return that you earned above that rate for taking on that additional risk. We're simply going to take that 11.3% and subtract off the 3.8% U.S. Treasury bill yield, and we find that our risk premium on this particular investment was 7.5%, but that's our nominal risk premium. We can use the approximate Fisher equation to find the real risk premium. That's simply going to be the nominal risk premium minus inflation. That is 7.5% minus the 3.5% inflation rate. So our real risk premium, accounting for inflation, on an approximate Fisher equation basis, was in fact 4%. That concludes this video. Good luck on the exam. Remember to smash that like button and subscribe to the channel. Until next time, goodbye.